You lose money when you save money in a low interest rate environment like the one that we're seeing right now, which is why one of the worst things that you can do is to keep following the 10% rule. What's up everybody, I am Jaspreet Singh from theminoritymindset.com, where money minds Rethink rich. When you're in a low interest rate environment like the one that we're seeing right now, the good news is you can go out and borrow money and buy a home and get a very low mortgage rate. The bad news is when you keep your cash in the bank, your money does not grow. If you deposit $1 in your bank account today, that dollar is gonna stay $1 in a year, and it's gonna stay $1 in 5 years, and it's gonna stay $1 in 10 years, but the price of everything around us is not gonna stay the same. As more money is printed and more dollars enter our economic system, the value of each dollar that we have, the value of each dollar that we save, and the value of each dollar that you go to work to earn gets diluted. And that's why your savings have less and less buying power each and every day. I'll show you what I mean, because Statista has been tracking the value of our dollars and the buying power of our dollars over the years. And so if you had $1 back in 1998 and you had that same dollar back in 2018, that $1 would have more buying power back in 1998 than it did in 2018. Over the span of 20 years, that $1 lost 38% of its buying power in just those 20 years. But let's go back a little bit further. If you had $1 and you put this dollar aside and this dollar did not grow, this dollar just stayed there. If you had $1 back in 1968 and you just kept that $1 there for the next 50 years until 2018, well then your dollar would have lost 87% of its buying power over those 50 years. And now let's go back even more. Let's go back 100 years, back to 1918. If you had $1 back in 1918 and you saved this dollar and that dollar did not grow, and over the next 100 years you gave this dollar to your great-great-grandchildren, well, the dollar in 1918 was a lot more valuable than it was in 2018, because over those 100 years your $1 lost 95% of its buying power. So if your great-great-grandparents were very wealthy and they worked very hard to put aside some cash and they were able to put aside an extra $50,000 for their great-great-grandson or their great-great-granddaughter, and they took this extra $50,000 and they put it into an account that didn't grow, and this extra $50,000 sat there until you were finally able to access your money now. And I know we're not in 2018 anymore, but you were finally able to access your money now. Well, this $50,000 might seem like a lot of money, especially if you're getting it for free, but back then that $50,000 would have had the same value that $1 million does today. There's a big difference between $50,000 and $1 million, and that's what happens when your money and your savings just sit there and they don't grow. And this is not even factoring in that we saw a lot of inflation happen in 2020 and 2021 because of all the money printing that we saw happen over those years. Just take a look at the Statista chart, which shows you the value of $1 and how it has dropped over the years because of the inflation that we're seeing around us. And we still haven't time to feel the real damage of all the money printing that happened in 2020 and 2021, and we're not going to know the effect of that onto our dollar until at least 2024. That's why in this video I want to go over what the 10% rule is, why you should not be following the 10% rule, and what you should be doing with your money instead. But before we get into that, I need you to do me a quick favor and smash the thumbs up button below. The 10% savings rule says that if you make $100,000 a year, or whatever amount you make, you are going to take 10% of that income. In this case, it's $10,000, and every year you're going to take this cash and you're going to put it away in the bank. You're going to give the bank this money and you're going to let this cash sit there in your savings account, and you're going to do this year after year after year. And if you stick with this, if you keep taking 10% of your income, you take a dime for every dollar that you earn and you just save it in the bank, and you do this from the day you start working until you retire, you're going to have enough money here in the bank for you to retire comfortably and wealthy, because you have saved 10% of your income for your entire working career. This, my friends, is one of the absolute worst pieces of financial advice that you can follow, especially in this type of economic environment that we're seeing right now, where this cash that you have sitting in the bank is slowly making you poorer each and every day, because the price of everything around you keeps going up while the money in your bank doesn't do anything. It's dead. If you deposit $1 in the bank today, in a year, it's still gonna be $1. But the things that you go out to shop for are not going to be the same price in 1 year, because inflation keeps making the price of things around us more and more expensive, and you can expect that to keep happening. So as things become more expensive, your savings sit there and do nothing. And if you just keep saving every extra dollar that you have, or you save a dime for every dollar that you earn, and you expect this money, your savings, to make you wealthy, if you expect your savings to be the money that you can live off of, you are living a lie, because your savings are slowly losing value each and every day. Go back to the example that I showed you just a second ago. If you had saved $50,000 100 years ago, you would have been rich, because that $50,000 has the same value that $1 million does today. But $50,000 today cannot buy you anywhere near what $1 million can, and you cannot live your retirement off of just $50,000. What you need to do is you got to stop giving all your money to the bank. Instead, you want to start doing what the bank does, because what the bank does is when you take this $10,000 and you deposit it in the bank, they don't just keep your money there in a vault and let it sit. They do something with that money. They take that $10,000 that you give them, and then they're going to turn around and they're going to invest it. They're going to try to grow that money, and then they're going to pay you nothing, because the interest rate that you get on the $10,000 is zero. This $10,000 that you put in the bank is not going to do anything. You're going to put this $10,000 there, and they're going to hold on to this $10,000, and they're going to nurture it, and they're going to grow it, and they're going to make more money for themselves, the bank, and then they're going to pay you nothing. See, what the bank is going to do is they're going to take your $10,000 and then they're going to loan it to your cousin Bunty, who wants to go out and they want to buy a home, or they want to go out and they want to buy a whole bunch of extra guac on their credit card. And now your cousin Bunty is going to pay your bank 4 to 20% interest, depending on if they're getting a mortgage or if they're getting a credit card, and your bank is going to pay you nothing. So it's the ultimate pyramid scheme that your bank is running, because every time you deposit some money in the bank, they're going to lend it out. And now if you go to the bank and you want to get this $10,000 back, the bank is going to be able to give you your money back, but it's not going to be your money. If you look at the serial number on your dollar, you're not going to get the same dollar that you gave the bank back. The bank is going to give you somebody else's money. Somebody else is going to go to the bank and they are going to deposit $10,000. They're going to give it to the bank, and then the bank is going to give you their money if you go and you ask for this money back. And so what the bank is doing is they're taking a whole bunch of people's deposits. They take your money, save a little bit, and then they lend it out to your cousin Bunty. They take this person's money, they save a little bit, and then they lend it out to somebody else. And they keep doing this again and again and again, on the hopes that not everybody is going to go and they're going to withdraw their money from the bank, because if they did that, then the banks would collapse unless they get a bailout from the Federal Reserve Bank. But that's how the banking system works. They don't just keep your money in a vault somewhere, because they know that this money that they have sitting there in a vault is doing nothing for them. The bank doesn't want to save their money because they know that saving is losing. So what they're doing is they're investing their money because they want to grow their money faster. So what you need to be doing is you don't want to just keep giving the bank all of your money. You need to be investing your money faster, so now your money is growing faster than 0%. That means that you need to start thinking like the banks. That does not mean that you need to start a pyramid scheme, and that doesn't mean that you have to start lending your money out. Although that is one way that you can invest your money, that's not the only way that you can invest your money and grow your money. See, even banks value the financially educated and the investors more than they do the people that are just saving their money in the bank. Because if you took your money and you saved it at Wells Fargo or Bank of America or Chase Bank right now, they would pay you nothing on your savings. But if you took this money and instead of putting it in Wells Fargo or Bank of America or JP Morgan, and you took this money and you invested it into the corporation, well, now this company is going to look at you a little bit differently, because they know you are financially educated and they're going to pay you more as an investor. Because right now, if you took your money and you gave it to Wells Fargo as an investor, as a piece of ownership in the company, well, then they'd be paying you around 1.6% a year in dividends. And this is just cash flow that you get just for owning the company, almost like the interest that you would get if you just saved your money in the bank. But in this case, it's cash flow because you own a piece of the corporation. And now the people that are running the company look at you a little bit differently because they know that you're financially educated. So they want to give you a better return. If you took your money and you invested it into the Bank of America Corporation, they would pay you 2% a year in dividends at the time we were recording this video. If you took your money and you invested it into the Chase Corporation, they would pay you 2.25% a year in cash flow through dividends, because now you're financially educated and you're not just saving your money in the bank, you're using your money to buy the bank. Now I gotta give you a little bit of a disclaimer, because investing money has risks. You are never guaranteed to make money when you invest. You might even lose money, so you should always do your own due diligence and never blindly listen to a random guy on YouTube. But this is what you gotta understand. Investing comes with risks. You have the opportunity to earn more money than you would if you just saved your money in the bank, because if you saved it, so I'll put this right here, savings, if you save your money in the bank, you are getting a guaranteed 0% return on your money. Now, if we took a little bit more risk and you invested your money, and this is just an example, I'm not telling you to invest in the bank, but this is just one thing that you could do. If you invested your money in the bank, these are the cash flows that you would be getting. Now, obviously you have risk, but this is where you have to do your own due diligence, and this is where you have to be financially educated. That way you know where to invest your money, but you got to understand that you need to be growing your money faster than this. Now, before I go over the things you should be doing with your money, I do want to let you know that if you are interested in learning more about investing your money in the stock market and building wealth in the stock market, our team has put together a free guide on investing in the stock market that'll walk you through different stock market strategies, how to research companies, and how to invest your money in stocks and get a consistent investment return over the long term. So if you want to know how to invest your money in the stock market, you can read this guide for free when you sign up for our daily newsletter, and I'll put the link to Hiking Dollar, our free stock market guide, in the description below. Now, when it comes to what you do with your money, the first thing you got to do is you got to understand the value of savings, because growing up, I was also told that if I wanted to become wealthy, I just have to save as much money as possible. My parents are immigrants from a state in India called Punjab, and I grew up with a very savings heavy culture, because traditionally the Indian culture is a very savings heavy culture. I joke around about this, but in the Indian culture, people make $1 to spend 20 cents, but in the American culture, people make $1 to spend $2 thanks to the help of debt and credit cards. That was the extent of financial education that I was exposed to. Go out and study really hard, that way you can get a big salary, and now when you have this big salary, spend as little money as possible and squeeze every penny that you can out of your salary and just put it in your bank savings account, because now your money is safe. You don't got to worry about losing money, and this cash is sitting there waiting for you to spend, even though you're never really going to actually spend that money, because you grow up with such a cheap mentality where you should never spend any money. See, the problem with that is twofold. Why would I want to bust my butt at work every single day to earn a big paycheck if I can never enjoy my money? And second, if I just save all of my money, then inflation is eating away at my savings. Your savings have a purpose, but that purpose is not to make you wealthy. You can think of your savings kind of like a cushion. It should be there to protect you against a financial emergency, and that's it. You need to have somewhere between 3 and 12 months worth of expenses saved in a savings account. Once you save that money, you never want to save another penny, because now your savings account is full. You have enough money to protect you if you lose your job, if your car breaks, if your window breaks, you have some cash to fall back on. But once you have that cushion, now you gotta stop saving more money, and you need to put every extra dollar that you have towards building your wealth. That means towards your investments. Now, this does not mean that you need to invest every single penny as soon as you have it. It means you need to put this money aside to be invested. You gotta have at the very bare minimum 3 different bank accounts, and each of these accounts are gonna have a different purpose. One account is gonna be your checking account, just your spending account. This is the money that you can spend. This is the money you go out to buy cars and clothes and shoes and vacations and nice restaurants with. This is the money that you're gonna be spending. One account is gonna be your savings account. This is the cash that you know is gonna be eaten away by inflation, but this is the cash that you have not to make you wealthy. It is there to protect you against an emergency. You need to have some cash here to protect you. This is your savings fund, okay? Then your third account is your investment account. There's a lot of different ways that you can manage this account, but what you need to just understand is that this money is the money that needs to be invested. Maybe this is money that you're gonna put into your stock brokerage account, or maybe this is money that you're gonna put into real estate investments, but this is the money that you're going to invest, that you know that you're not going to spend, that you're not going to save. This is the money that you're just waiting to invest. The way you invest your money is going to depend on your goals and your risk tolerance. I invest my money more than one way. When I invest in real estate, I'm looking for cash flow. When I put my money into the stock market, when I find an undervalued company, I'm looking for long-term appreciation, and I also have an account that's automatically taking cash out of my bank account every single week and is automatically investing this money into ETFs in the stock market. So there's different strategies for different goals, but you need to know what your goal is, and you got to start putting some money towards this goal. Our dollars are going to be diluted more. That's a fact. And even if we see interest rates start to go up, chances are the interest rate in your bank account is not going to go up as much as the inflation around you. So even if your bank account starts paying you 0.5% a year in interest, chances are it's not going to be beating inflation, which means, hey, you're getting 0.5% a year on your savings account a few years from now, but the price of things around you are growing by 3%, so you're still at a net loss. This is why financial education is so important. That way you can use your money as a tool. That way you can become wealthy instead of being the person that's just being screwed over by the system. If you loved what you saw so far, you're also gonna love this. Retirement is a really weird concept. Personally, I hate the whole idea of traditional retirement where you work from the age of 21 until 65 or 67, and then once you hit that age, then you can quit your job finally and then do nothing until you die. Well, I guess some people look at retirement as the time when they'll finally be able to travel and finally be able to go enjoy the world and enjoy their lives. But why do you want to start enjoying your life when you're old? This is one of the reasons why people say those who retire early die early, because when you're sitting in retirement with nothing to do except watching reruns on TV all day, every day, you feel like you have no purpose. I would much rather like to see you change the whole idea of retirement from working this job that you hate for 45 years so you can ultimately quit and do nothing, to doing something that you love, and then when you hit retirement or financial freedom, that now you can kind of scale back while continuing to do what you love while spending more time traveling and spending more time with your family. If all you know is your job and this is what you're looking forward to day after day after day, then when you hit retirement, it is going to be a very sad day, because then you're not going to be able to go back to your job and you're going to feel like you have nothing to do. Like, there was an uncle of mine who used to be an engineer, and he worked this engineering position for decades. And as soon as he retired, he immediately started having all these health problems because he was doing nothing except sitting on his sofa and watching TV all day long. And so he went from this healthy person to immediately becoming this old person, like almost overnight, because he started having so many physical health problems. He went into depression, and it created all these problems just because he hit retirement and had nothing to do. Now, while that issue is kind of like, what do you do in retirement and how do you live your life? The second issue is the financial side of the issue, because CNBC has made it clear that millennials are financially screwed when it comes to retirement. Well, at least the people that don't understand money, that is. The whole idea of retirement, strictly financially speaking, is you can now live life the way you want without having to worry about money, because you have built up this nest egg, these savings or this investment or whatever. This income or this nest egg that you have created will now be able to fund your life. That way you can live your life without having to go to a job in order to get paid. Previous generations never really had to stress too much about retirement, because if you followed the system where you went to school and you got a good job and you put in your time at your job, then you were pretty much guaranteed a pension or social security or both, so you could be able to live your life and retire kind of without really that much stress. With millennials, it's a little bit different, because now you got a plan for your own retirement, and if you don't start doing this early, you're gonna pay the price later on, and that's what I'm gonna be talking about in this video. So if we go back to the CNBC article, this article is based off of research from an MIT economist, which says that millennials want to retire by the age of 65. It says that a third of millennials want to retire between the ages of 65 and 69, and another 43% of millennials want to retire before 65. So you have the vast majority of millennials that want to retire at 65 or earlier. Now, you have all these millennials that want to retire at 65, but when it comes to actually planning for retirement and putting money aside for retirement, only half of millennials are putting aside more than 6% of their income into something like a 401k or any investment to help actually fund their retirement. And only 1 in 5 millennials are saving or putting aside more than 15% of their income to actually fund their retirement. But it gets a little bit worse. So what this is saying is that 3 out of 4 millennials want to retire by the age of 65. A lot of these people want to retire before the age of 65. But now, half of millennials, about 50% of millennials, are saving or putting aside 6% of their income max. So this is like the maximum amount of money they're putting into the 401k, while only 20% of millennials are putting aside 15% of their money or more into the 401k. So this other 30% is saving somewhere between 6 and 15%. So you have the vast majority of millennials who want to retire at 65, but now the vast majority of millennials are also saving or putting aside less than 15% of their income. Now, when I say saving, I don't mean putting this money into a savings account. I mean putting this money aside for your retirement into something like a 401k or your other investment accounts. 80% of millennials have less than 15% of their paychecks going towards their retirement accounts. And this article says that if millennials want to be able to retire, you got to be saving 40% of your income for the next 30 years to be able to live a retirement where you're living a lifestyle where you're just pulling out half of your final salary before you hit retirement. Now, the reason the economists are saying that this money that you're putting aside towards retirement isn't enough is because they predict that the stock market, where this money is going, right? When you put your money in the 401k, it's going into the stock market. They think the stock market is not going to grow as fast as it used to. They say that in the past, the stock market used to grow by an average of 10% a year, but in the future, they expect it to grow somewhere between 3 to 5% a year. Some companies like Vanguard actually predict that it will be below 2% a year for the next decade. That's concerning because if over the next couple of decades, when people are trying to build their wealth, you only see your money grow by 2 to 3% a year on average, then you're not going to be able to build the wealth that people were able to do in the past, because in the past, people saw their money grow by 7, 8, 9, 10% a year on average. And so that can affect how fast your money compounds, because when it comes to compounding your money and building wealth, there's 3 factors you got to look at. You got to look at how much time your money is invested for, you got to look at how much money is invested, and then you got to look at the interest rate. You cannot really change too much about the time unless you start earlier, but you cannot change the past. So the next best thing you can do is start investing your money today. When it comes to how much money you can invest, obviously you can try to invest more money, but it can be hard for some people to invest half of every dollar that they earn. And the third thing we can look at is how fast your money can grow. And if what they're saying is true, where money's not going to be able to grow as fast, then that's going to hurt a lot of people when it comes to building long-term wealth. Let's take a look at it. Let's assume that you are making $50,000 a year. And for the sake of this example, I'm going to assume that there's no inflation in this world. So you are going to make $50,000 a year every single year until it comes time for you to retire. And I'm going to assume that you are investing 15% of every dollar you earn before taxes. So 15% of $50,000 means you are investing $7,500 a year. If you can do this, and you do this for the next 30 years, well, over those next 30 years, assuming you get a 2% annual return on your money, then your money is going to grow to $323,000. If you can get a 3% annual return on your money, then your money is going to grow to right around $380,000 when it comes time for you to retire. Now, the problem here is if you want to live off of $50,000, because this is what you're used to, this is what you've been making every single year, then even if you make 3% a year on your money, then this money is going to last you less than 8 years when it comes time to retirement. So if you retire at 65, you're going to be broke by the time you're 75. And even if you're living off of just half of what you made as a salary, so if you're living off of $25,000 a year, you're still not going to get 20 years worth of income from this money, assuming you don't keep investing your money when it comes time to retire, because you move your money into something safer like bonds where you're getting even lower returns. If that's the case, then this money is not going to take you to 85 years old. You're going to be broke in your golden years of retirement. If what these economists say is true, that millennials are only going to see a 2 to 3% return on their money over the next few decades, then this is very, very, very bad news for millennials, especially because only 1 in 5 millennials are putting aside 15% or more for retirement, while the vast majority of millennials are doing way less than that. Now, if you are a millennial and you're watching this, there are things that you can do. That way you can get better returns on your money. And I'm going to get to that in just a second. But the reason why these economists and these financial institutions are kind of predicting these lower returns in the future is because they think that our United States economy has grown so big that we're not going to be able to grow as fast. You can kind of think of our United States economy like a company, because when a company is small and is in the startup phase, it can grow a whole lot faster than it can once it becomes mature and bigger and older. Like if we look at Amazon, for example, in the first decade that Amazon was in existence, they were growing by 100% a year. But now that they're so big, you're not going to see them grow by 100% a year every single year over the next decade, because they're so large. There's not that much market share that they can grow by that quickly. So the bigger you are, the harder it is for you to grow as fast. That's why when you invest your money into a blue chip stock, like a bigger company, something like McDonald's, you're not going to expect to see your money double overnight. Versus if you invest your money into a startup like maybe Tesla or Peloton, you can see your money grow a whole lot faster, because these companies have the ability to grow a lot faster because a lot of people are not buying or using their product yet. and so they have a whole lot more market share that they can take, and so they can grow very quickly. So the smaller you are, the more potential you have to grow faster. If you look at the United States economy back before the 2000s, you would see our GDP, our economy, grow by 5, 6, 7% a year. But now we are happy when we see our economy grow by just 2% a year, because our United States economy has become so large. I mean, we are a massive economic superpower. And when you become that big, it becomes so much more difficult to maintain that same rate of growth that you saw before. And so in order to keep growing quicker, you might have to take on more risk. I already made a video talking about how our economic system works. If you want to learn more about that, I will link a video where I explained it in the description below. So the whole idea is, because our economic system and our economy is so big now, we can't grow as fast as we once did, because our economy is already so large, and so we kind of have to expect smaller returns. But just because that's the case for the overall economy doesn't mean that you have to accept these smaller returns, because there's other things that you can do with your money to kind of balance this out and get better returns for yourself. Now look, I gotta give you a little bit of a disclaimer here, because investing has risks. You are never guaranteed to make money when you invest. You might even lose money, which is why you gotta always do your own due diligence and never blindly listen to a random guy on YouTube. In general, higher risk comes with higher potential return. So what you want to figure out is how you can get this higher potential return while kind of mitigating your risk. One way that you can mitigate this risk is by learning and finding alternative investments that can get you better returns, and because you learn and know how to do this, you can lower the risk while getting the higher returns. One thing that we're going to see over the next decade is cheap money. I mean, we have interest rates that hit rock bottom in 2020 and 2021, and they're going to stay low for a long time, and so we have this huge influx of money into our economic system, and this money has to go somewhere. One of the places this money can go is into startup companies, and so startup companies can borrow money very inexpensively and use this to start and grow companies. There's a couple different ways that you can invest in these innovative and growth companies. You can go out and find the individual companies to invest in. So you can go out and find these startups, and you can do the research on them, and you can study their financials, and you can see who is a good person to invest in, who is a good CEO, who has a good executive team. And when you find a company that you like, you can invest your money into it. But then you also got to do the upkeep. You got to listen to the earnings calls. You got to see how much money they're making. You got to see how they're innovating, because you want to make sure that your money is in a good place. I don't recommend this for the majority of people, because this takes a lot of work and a lot of time. And if you're not willing to put in that work, then you are taking on all the risk without mitigating it. Because when you're investing in startup companies and these innovative companies, there's a high chance that these companies can fail, because it also comes with more risk. The alternative is you can invest in an ETF, which is a fund that gives you exposure to a bunch of different companies. So there are ETFs out there that gives you exposure to growth companies and innovation companies. So these are ETFs that give you exposure to a whole bunch of different companies, a whole bunch of different stocks. So if one company in your fund goes down, then you're okay, because this fund will have a whole bunch of other companies, but you're getting exposure to a general group of stocks. So there are ETFs that give you exposure to growth, like VUG. This is a Vanguard fund. And there's innovation ETFs like ARKK. ARK. Again, these are just examples. I'm not telling you what to invest in, but I do gotta let you know that I do have some of my own personal money in this ARK fund. But these are funds that you can invest in that will give you exposure to growth companies up here or innovation companies over here. ETFs work just like stocks. You can buy and sell shares of these ETFs right on your stock brokerage. And if you go and do a little bit of research, so do a Google search on either of these ETFs, you'll see what companies they invest in and what their investment goals are. The thing that you have to understand when it comes to investing your money in ETFs is your goal here is long-term growth, because ETFs are not things that you should be day trading. These are things that you want to be investing your money in for the long term, because you believe in the companies that these funds are investing in. So you believe in innovation, and you believe in growth, and you like the companies that these funds are investing in, and so you want to own a piece of that fund to have you get exposure to these companies. And the key for this to work is you got to keep consistently investing some of your money. I say at least 15% of your income every time you get paid into these funds, and this is something you got to be doing for years, right? Because we're talking about building this financial freedom, and so the goal here is not to see your money go up in a month, is to see your money grow consistently over the years. Now, before I get off the topic of these ETFs, if you do want to learn more about how to invest your money in ETFs and how ETFs work and how you can find a brokerage that automatically passively invests your money into an ETF like this for you every time you get paid, that we don't got to worry about it, our team wrote an amazing article that will walk you through exactly how to do that. I'll link it for you in the description below. The third way that you can beat the returns of a slowing stock market is by investing your money in real estate. But there's a few different ways that you can invest your money in real estate. One way is through REITs, R-E-I-T. I'll explain what that is in just a second. Another way is through crowd-funded real estate. And the third way is through rental properties. I gotta get me a new black marker. REITs stand for Real Estate Investment Trusts, and these are things that trade on the stock market. Now, when you invest in a REIT, you're not investing in an actual property, you're investing in a company that invests in real estate. So you can invest in REITs that invest in apartment complexes, you can invest in REITs that invest in strip plazas and commercial buildings. There are REITs for all different types of real estate. The interesting thing about REITs is that REITs are required by law to pay out 90% of their taxable income, so the rental profits, to the shareholders, people like you, through dividends. And so many times you're going to see REITs that are paying out dividends more than 3% a year. This is in addition to stock price appreciation, which you're hopefully going to get. So when you buy shares of a REIT, you're going to hope that the price of your shares go up. But in addition to that, every 3 months or whenever they pay out a dividend, you are going to make this passive income. Crowd-funded real estate is a little bit different. This is a way for you to get exposure to physical real estate without having to buy an actual property yourself. So what you're doing here is you're investing your money into a fund. This is not something you do on the stock market. You got to use a crowdfunding service. I'll have articles and resources for you in the description below if you want to learn more about how to do that. But you're investing your money into this fund, which gives you exposure to physical real estate. So you might be investing in a fund that gives you exposure to prime-time apartment complexes in Miami, or it gives you exposure to prime-time developments in LA. Essentially, you're investing your money into something that gives you the same returns that a physical property is giving you. The advantage of this is now you will get appreciation and dividends from your rental income. And you don't got to worry about dealing with tenants or finding properties or dealing with property managers. You're just investing your money into a fund. The third way that you can grow your money faster is by investing your money into rental properties, especially value-add rental properties. So this is my favorite place to invest my money. When you invest your money into a rental property, you're going to buy a physical property, let's say a house. And once you own this property, you can lease this property out to somebody else, so a family can live in your house, and every single month they're going to have to pay you rent for living in your property. So not only are you getting passive income, but if housing prices go up and real estate prices go up, your property values are going to go up as well. Now, to put this in perspective, if you invest your money into a REIT, typically you are going to see dividends paying you somewhere between 2 and 10% return a year. The higher the dividends, the higher risk, but these are pretty standard when it comes to REITs. So somewhere in the 2 to 10% a year, and this is consistent passive income you're gonna get for just investing your money into a REIT. When you invest your money into crowdfunded real estate, you're typically gonna see somewhere between 6 to 9% a year. At least this is what I've been seeing in the past, and I have some of my money in crowdfunded real estate, and these are the type of returns that I've been seeing. And when it comes to rental properties, this is really going to depend on which area you're in. But if you're in a big city, you're going to see lower returns. If you're in somewhere like the Midwest, then you can see much better returns. Me, personally, I'm looking for something between 7 and 8% cash flow a year. The reason I like this is because this number typically goes up over time because rental prices go up, and so you make more money and you own something physical and tangible. Plus, when you own physical real estate, you also get tax breaks because the United States tax code gives a lot of loopholes to real estate investors. Now, I know this is not easy. This is more work. This is going to require effort on your part to learn how this works and actually put in some time and some money to invest here. And yeah, you're going to go through a learning curve. There might be times where you lose money. I even talked about my worst real estate deal ever on YouTube. There are times where you will lose money, but these are things you got to go through if you want to be willing to get the higher returns. That way you can actually build your wealth. Because if what these people say is true, and you're only going to see 2 to 3% returns over the next decade or decades on average, then it's going to be much harder for you to build your wealth. And so this is where you got to really break away from the majority of people. I mean, that is why we call ourselves the minority mindset, where now you are taking care of yourself and your finances, because you do not want to run into a situation where you have to rely on someone else like the government. That way you can be able to live your life. This is where financial education is so important, because most of us are never taught about the different ways that we can grow our money. We're just taught to go to work and invest our money in our 401k. But if that's not working, or if it doesn't work in the future, you gotta know how to start planning your money today. That way you can live the life you want when you want. Thank you for watching. If you enjoyed this video, here's the video on how the system keeps so many people poor. And while you're at it, download our free guide on how to start investing your money in the stock market. And as always, keep hustling. My parents immigrated to America. They didn't know the language, they didn't know the culture, they didn't know the people, and my dad said he had less than $100 when he came to America, but he had to make it work. And so now you're working off of hard work and education just so you can survive.